Hello guys, on today's class we'll be talking about moving averages in forex trading. It's one of the most strategic approach to market analysis, and we get to it. So in the table of contents we'll be talking about basically the basics of moving averages, the types of moving averages, the calculation methods of these moving averages, the applications of moving averages, the advantages and limitations to these moving averages, and accompanied with real-world examples, tips and best practices, and risk and conclusions. So, what is a moving average? That's what's important. Now, this is one of the most popular technical indicators or tools used by traders to smooth, the word smooth. Now, to smooth out price fluctuations in the market, distinguishing between the typical market noise and the actual trend direction. Like if you're a new trader, you come into the market, you get confused. Like you see lots of candles, you see lots of reactions, you see lots of price reactions, you see an up and down swing, you see a diagonal moves. It gets distracting. And then you have professional traders who tell you it's an uptrend. And then you're wondering, how exactly can I identify this? Now the moving average helps you be able to clear out these noises that come in the market. So you wouldn't have to stress yourself to be able to go about trying to find out some specific moves and direction in the markets. The moving averages is there to help you ease out the process. It's a simple term, like it helps you gives a clear incentive of the direction of the market and the price in the market. It's like having a tracker. You know, if you have a tracker on a device, it helps you locate a missing item faster, which is very efficient. So that's exactly what the moving average does for you. Instead of having to look for trends in the market, look for where the market is going, the moving average will do it for you. Now we have two types of moving averages. You need to know there are two types of moving average before you begin to use this moving average. You have to know there are two types of moving average in forex trading or crypto trading. They're all similar and they're all alike. So we have the simple moving average, which is the SMA, and we have the exponential moving average, which is the EMA. Now the SMA is calculated using previous data in the market by a certain amount of candles, a certain amount of X candles, maybe 10 candles, 20 candles, depending on the length and the length of the SMA moving average which you would put in your settings. So that is how a simple moving average is calculated, while the EMA is calculated using present data on the markets. That is to say, it follows the current action of the markets. It follows the exact current action of the market. So as the market moves, the EMA moves. So SMA takes prices of previous data, and EMA takes data of present data. That is the simple term. That's the easiest way I can describe an SMA and EMA for you. Now, the advantages of SMA, it's simplicity. It has a lot of simplicity to it, and it's easy and it's very good for interpretation. It smooths out the noise, which I have explained in terms of trend directions, and delayed response for long-term trends. So it helps give you a very clear incentive for a long-term trend. Now, the disadvantages of this SMA, simple moving averages, is that it lags in response to price changes because it calculates a so amount of data before it moves. So obviously the recent action in the market might not be shown early enough in the SMA, in the simple moving average. So that is one of the disadvantages. It lags in response, and it equally weighs and ignores the recent trends. So it ignores the recent trends because it calculates a previous data. So a new data of a so amount has to be created for it to readjust. Now, the advantages of exponential moving average, like I said, the exponential moving average calculates the present, current, or recent times in the market. So it's quicker to respond to price action, and it reduces lag effects, unlike the SMA that it's quite slower, and the adaptability to trend changes is magnificent. It follows the action of the trend. As soon as the price moves, it moves with it. So these are one of the popular advantages of an exponential moving average. Now, the disadvantages of this EMAs are complexity in calculation. It's very, very hard to calculate due to it taking the present price reactions, but you don't have to calculate it because the application TradingView will do it for you, or the app application where you trade will do it for you. So you don't have to worry about that. And another disadvantages are greater sensitivity to price fluctuation. So if the price is fluctuating so much in a fast manner, the exponential moving average might move in a fast manner, most times giving you a wrong incentive towards the direction of the market, because it's following the direction of the market. And if the market decides to go quickly up and quickly down, it follows the trend. And you might think there is a trend, but there is no trend because the price is just fluctuating, looking for liquidity sweep. And there's high potential for overreaction. So you might think there's a big move in the market, there's a big spike in the market, it's going super bananas, it's going up, but it's actually not going up. It's just readjusting to the price movement and the price sessions. So real life examples of moving averages. Like I said, it helps you smooth out the noise and gives you a very clear directive towards the direction of the market. And if you have a quite clear incentive toward the direction of the market, you can tell where you want to go in the market. For example, in my moving average, I use a 50 moving average, 50 EMA moving average. It helps me give me a clear incentive towards the direction of the market. Now, if the market sits on the bottom of the moving average, then it means that the market is heading towards the up direction. And as you can see, instead of having to draw the lines, which I had showed you in the previous class for an uptrend, you can easily use the EMA, this 50 EMA, as a support to know where the market is going. And you can use it as support. Whenever it bounces towards the line, you can take a buy and close your sell. And when it comes back to the line, you can buy again. It's very simple. It's not rocket science. And this is a trend confirmation towards the down direction. Like I said, if the EMA is on the bottom, if the 50 EMA is on the bottom, then you're looking for a buy. If the 50 EMA is on the top, you'll be looking for a sell. And whenever the price hits the 50 EMA on the top, you'll be looking for a sell action. And as you can see, it touches the EMA and then it goes down. It touches the EMA and then it goes down. It's very simple. A downtrend, you can see it when the EMA is on the top, and a bottom trend, when the EMA is on the bottom, then you're looking for an uptrend. It's very simple, guys. And then, as you can see, on the EMA is on the top, you're looking for a sell. When the EMA gets to the bottom and the price goes on top of it, you're looking for a buy. So you can see a very clear sweep of a down direction and a change in trend on the up direction. Now, like I said, I just showed you an example of how the EME can go for an up direction to a down direction, or a down direction to an up direction. Now, the most common way to use this indicator, most people do, is what they call a crossover. Now, they call it a moving average crossover because once this moving average is crossover, it indicates a change of character, a change of trend, and a change of market directions. So you can see I have used the EMA 50 and the SMA 10. Now the SMA is much more slower, like I said, so it takes time to calculate, and the EMA is faster. So the 50 shows it has a bigger further resistance, and the 10 has a smaller resistance. So if it's calculating the previous 10 candles, it's easier for it to be able to aid in its direction. So I don't want to waste time in the class, so I'm going to show you how you can use these crossovers to indicate the change of trend. So once you can see the 50 EMA on the top, it's holding for a sell direction. You can see they are both simultaneous in the direction. And then it goes down, you can see the sell, you can see the sell, you can see the sell, you can see the sell. And now you can see it crossed over, but the SMA still went below. So since the SMA is still below, you're still having a sell. But once the moving averages cross over and the SMA goes towards the other direction, now you see the SMA goes towards the up direction, you can tell there's a change of trend. Now you can see the uptrend has begun. and now it has climbed the EMA, 50 EMA, and the SMA shows the direction of the markets. So it's quite simple, using a crossover, using multiple moving averages to be able to direct or to find a trend change, and using the moving average to be able to identify the trend in the markets. It's very simple, guys, and I don't think it's that hard. So moving on, how can you find this moving averages in the market? How can you use it, and how can you find it? It's very simple, guys. So when you go to TradingView, you click on the indicator, and when you click on the indicator, you're going to see a pop-up indicator, metric, and strategy. And then you click on the search button, you have to type moving average. So here I have the moving average simple, which is the SMA, and I have the moving average exponential, which is the EMA. And then when you click on it, it takes you to the settings, and then you set it. So I have the 50 length, and then you can set whatever you want to use. The most popular moving averages used by other traders in the market for the 1 hour charts are 5, 10, and 62. I'm more of a 1 hour trader. I look into the 1 hour chart in order to find my entries and trend directions, and then I look for sharper entries in a shorter time frame, more like a 15 minutes time frame. But we'll go into it in the class. You'll be able to identify if, due to your attention span, due to how much time you have at hand, to know if you would be an intraday trader, a swing trader, or a scalper.